Hey friends, welcome back to the channel. As you probably know, the Olympics are starting at the end of July. I actually began my journey as an investor around the time of the London Olympics, way back in 2012. At that time, one of the few people I knew who was like me and really interested in investing in stocks told me that he was investing in Adidas because he believed the Olympics were essentially a massive marketing event for the entire athletic retail business. And this would result in free advertising and prime Adidas for explosive future growth. And he happened to be right. Adidas saw some pretty great growth after the 2012 Olympics. But was this causation or correlation? I accepted it as causation at face value and never really tested to see whether or not the Olympics had an impact on the stock market in general, or even if it helps athletic brands. And if you've been following this channel for a while, you know I have some skin in the game here. I have a public portfolio where I'm investing $100,000 of my own money. And right now, 60% of it is in short-term government bonds as I look for new companies to invest in. 10% of it is in Disney, who I think has been oversold, and 30% of it is in athletic brand Lululemon. I didn't have the Olympics as part of my thesis when I started doing my due diligence for Lululemon, but if there is a boost to be had from the Olympics, I'll be interested to learn about it and see if Lululemon or any other company stands to benefit from it. And after digging into it, it turns out there's a good bit of academic research on the effects of the Olympics. But before we get started, our producer Jason is actually out for the next couple of weeks. And there literally could not be a cooler reason why he's out. NBC recruited him to produce the freaking Olympics. So he'll be busy doing that. And the quality of these videos might be a little bit lower than you're used to, but I'm trying. We missed the hell out of you, Jason, and cannot wait until you're back. But man, are we proud that we get to work with you. Okay, let's start with how the Olympics may or may not affect the stock market in general. Then we'll go in to see if it affects retail athletics. The most comprehensive study I found is titled Media Attention and Stock Categorization, an examination of stocks hyped to benefit from the Olympics. And that title, although it is wordy, is kind of perfect. The study compares the past 5 Olympics, focusing on what they call Olympic stocks, which are stocks that are directly related to the host country. They give some examples of Olympic stocks later in the paper, and examples include those in airline, construction, hospitality, media, and service industries that contribute to the broader Olympic experience. The punchline of this 68-page peer-reviewed research paper is that these Olympic stocks exhibit increases after the announcement of the winning bid and declines after the games are played. However, they mention multiple times in the paper that the fundamentals of these businesses typically do not change significantly at any period during the Olympic cycle. So this means that any rise in stock price with no underlying change to the business is purely hype. And hype is probably the worst reason to find an investment. As Buffett's mentor Benjamin Graham once said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And the real gains are found in focusing on the long run. This has been proven true time and time again, especially for us individual investors. Okay, so if Olympic stocks in the host country go up before the Olympics, but then down after the games are played, what happens to stocks during the games themselves? Well, it turns out this is almost as interesting. It turns out there are short-term positive effects. According to Bespoke Investment Group, since 1928, the S&P 500 has averaged a 1.75% increase between the opening and closing ceremonies of the Summer Olympics. And an overall net rise occurs about 55% of the time. And bear in mind that this is inclusive of the 2000 games and the 2008 games, which occurred during the dot-com crash and the Great Financial Crisis, respectively. But there's another really interesting phenomenon at play here. The Wall Street Journal reports that researchers found, quote, clear evidence in the country whose team loses becomes gloomy, and as a consequence, more pessimistic about equity's potential, leading that country's stock market to perform poorly the following day. However, the flip side isn't true. If a country's team wins a major event, stocks do not see a rise in prices. This is interesting, and the article doesn't really explain why, but I think that the explanation falls somewhere in the realm of behavioral finance. Our human brains developed to protect ourselves so that we could go on to raise offspring and protect them to carry on our species. This evolutionary biology has translated to a behavioral finance term called loss aversion. And that partially explains this, in my opinion. So during the Olympics, we may see a modest rise in stock prices, but it won't necessarily be tied to any fundamental changes in the underlying businesses. Any Olympic businesses that benefited from the rise will most likely revert back to the mean after the games are over. Historically, the games have caused stocks to go up modestly, but if a home team's country loses, the stocks in that country will go down due to loss aversion. This all goes to say that I don't think it's a good idea to try to price in any effect that the Olympics may have on the overall stock market. I believe in long-term fundamental investing. And the reason is we don't really have the ability as individual investors to see what the professionals on Wall Street can see. They have a lot more data to work with than we do. And the markets are forward-leaning and mostly efficient. So prices already reflect the expected impact of the Olympics. Professional investors know how to price in well-known effects well in advance. And the Olympics occur every 4 years, so it's a really certain effect. We, as Buffett-style investors, are looking for great companies trading at fair prices. And so this goes into the second part of the discussion. We should look for companies that could benefit from being on the global stage rather than just riding a short-term sugar high from the Olympic hype. So for the rest of this video, we'll get out of the Olympic businesses talk and go into the athletic brands. And the literature is not as precise here. It's a little bit harder to nail down in terms of academic research, but we do know athletic brands do focus on the Olympics. Athletic brands see the Olympics as a way to increase brand exposure and brand reputation, which Morning Brew Child company Retail Brew reports that retail brands earned an estimated $100 million through the sales of licensed product during the 2020 Tokyo Games. I think historically, one of the most prominent brands seen during the Olympics is Nike. And looking back historically at their data, Nike has seen sales rise an average of 9.9% during Olympic quarters, compared to a 7.9% during non-Olympic quarters. And there's a lot of interesting things happening at Nike right now. Let's zero in on Nike because that company has gotten the absolute crap beaten out of it lately. Nike ended June battered and bruised. They just reported their fiscal fourth quarter revenues, and they were down 2% to $12.6 billion, with Nike direct revenues falling off 8%, dropping to $5.1 billion. Sales ended the year up 1% to $51.4 billion, and the market reacted violently to Nike Direct going down, since that's seen as their key initiative. The stock price is down almost 30% year to date. Another key issue that caused the street to react so negatively is that their CEO forecasted that next quarter sales, which is an Olympic quarter, would be down 10% during that quarter. I went through a bunch of their quarterly reports, and that's an unprecedented level of decline during an Olympic quarter. So this does smell like opportunity. But the key question is, can Nike grow out of this? Let's first go into how they got into this mess. I think it comes down to a couple points. Nike Direct coming online late, which is their direct-to-consumer arm. Lululemon's been doing it for years, and it allows you to know the customer better. It is definitely the future of the company, but their rollout has been shaky. And analysts believe that they shifted too rapidly from their retail partners to this direct-to-consumer model. But then the second issue is that they're stagnating on their product innovation, specifically footwear, which accounts for 64% of their revenue. They said on their most recent earnings call that they are accelerating their innovation pipeline, but that won't be available until the spring of 25. So they're asking investors to be patient here. And this seems like a turnaround play instead of overblown news. I try to stay away from turnaround plays. Buffett has a famous quote where he says, "Turnarounds seldom turn." But anytime we've seen a turnaround happen, it starts from the top. Think of Apple when Steve Jobs returned in 1997. Or Hubert Jolly's ability to fend off Amazon and make Best Buy a pretty good performing company. Or Patrick Doyle reviving Domino's brand. Or heck, even Satya Nadella at Microsoft. Turnarounds absolutely can happen, but it all comes from leadership's vision. So let's look at who runs Nike. That's John Donahoe. He's got a pretty interesting career. He started off as a consultant working for Bain & Company, where he eventually rose to CEO by 1999 and sat in that role until 2005. The company saw some really great growth during this time. And interestingly enough, Nike was one of his clients at Bain. He then went on to run eBay from 2005 to 2015, which if you were around during this time, you saw eBay go from the preeminent e-commerce company to getting their lunch handed to them by Amazon. So he left the front door wide open. I view that as a black mark on his record. He then went to ServiceNow and had mixed results. So there's a couple issues I have with John Donahoe at Nike. He's a smooth talker, which is common in a consultant. But I think as an operator, he's had too many mixed results. I also think he's jumped around industries a bit too much. I have two requirements when it comes to my CEOs. They have to be skillful and they have to be honest. There's nothing to make me think that he's not honest, but this is his real first time in athletic retail. And I do have some bias against management consultants here, but I'm also not alone. Neither do Buffett or Munger. Charlie Munger has a famous quote where he says that he would rather throw a viper down his coat than hire a consultant. He was referring to compensation consultants for that specific quote, but the feeling is similar for management consultants. So in general, at this time, I'm not really seeing the turnaround story for Nike, but I do believe that these disastrous results will either start a fire under the company or will allow newer entrants, Lululemon, to begin eating up market share. Lululemon recently entered the footwear game, and when you think about the fact that it makes up the majority of Nike's revenues, you can see the strategic positioning here to start breaking into footwear. As long as they do the rollout well, which looking at the reviews for Lululemon's footwear, it seems like the market is taking it well. One of my favorite things about being an investor who invests in what he knows is that I have no problem purchasing products from the companies that I own to battle test them. And my wife has recently gotten into running, and so I bought her Lulu's shoes, and I'm interested to see how she likes them. It is possible to do this by reading reviews online, but I find that actually seeing the product helps me get a better sense of it. One of my largest investments in my non-public portfolio is Apple, and I recently bought the Apple Vision Pro to see if I thought that this would be an innovative product. I think that it's close, but I don't think it'll lead to a revolution. The Vision Pro has a lot of problems, but I do think it shows that the company is continuing to innovate. And my justification is that I've made a lot more money off of my Apple stock, which I've owned since 2012, than any expenses from purchasing their products. And it's great to keep tabs on the company. That's all for this episode. If you enjoyed it, please give us a like and subscribe. It'll help us get this content out to more people. And if you really, really liked it, please consider supporting us by joining our Patreon, where you'll get early access to our Flank platform. Our mission at Flank is to tangibly reduce the wealth gap by empowering individual investors and restoring stakeholder capitalism. The first way we plan on working on this mission is to create the world's first purely long-term fundamental data platform that views public companies not as stocks, but as businesses, and to make that analysis less lonely, boring, intimidating, and overwhelming. We created a Buffett-style research framework that essentially walks you through exactly what to look for while doing your due diligence. And we've made that research social so that you can see how other intelligent investors are looking at the businesses you're looking at, as well as getting constructive feedback on your own analysis. Right now, since we're just getting started, our volume is low enough that I can comment on every single analysis that gets posted. So it's a perfect time to join. Thanks again, and we'll see you next time.